So get this. The head of the IMF is saying that bank runs happen because people can move money too quickly. So the solution is that we shouldn't allow them to move money right when they want to. We should lock their money in banks if they feel that there's going to be a bank run. So what do you think is going to cause a bank run if there's a new law that you can't take money out if there's a bank run? It's going to cause a bank run. Well, hello there, my friends. Rafi here from the Endgame Investor with this week's Silver Report for Arcadia Economics. And today we're going to talk about the IMF head, whose name is Kristalina, who thinks that regional banks are collapsing because of incompetence. But we're going to go into the real reasons, and we're going to show you 3 banks that illustrate these reasons that have nothing to do with incompetence, has to do with institutional corruption. And why do I keep talking about myself in the plural? I don't know. I shouldn't do that anymore. It makes me seem schizophrenic. We're going to go a little bit into gold and silver technicals and why I think we are on the verge of an imminent breakout to new all-time highs and beyond all-time highs, I should say. In gold and silver should follow. Not that silver's going immediately to 50, but it should break out to the upper 20s, I think. The silver to stocks ratio is at 5-year resistance, and the treasury is down to about $291 billion, and why we should know if D-Day on default and the debt ceiling is going to be June 1st or sometime later in September. We should know that by the time you're watching this, and I'll explain why right now. This week's Silver Report is brought to you by Shroomy the cat, who's taken way too many mushrooms. Well, it's actually brought to you by Fortuna Silver Mines, symbol FSM. And what can we report about Fortuna this week? Well, back on April 28th, it renewed its stock repurchase program for investors. They can repurchase up to 14,534,581 shares, not 580, 581 shares, which is 5% of its outstanding common shares as of April 25th. Fortuna will be announcing its earnings on May 15th, about 10 days from now, and we will cover those here on the Silver Report, as well as, I'm sure, with Jorge Ganoza, CEO of Fortuna Silver Mines, on Arcadia Economics when they come out. First thing we're going to cover today is the statement by the head of the IMF, Kristalina Georgieva. Sounds like it could be a good stripper name. And don't forget that the previous head of the IMF, and I'm not talking about the criminal French woman, what's her name? Lagarde. I'm talking about Dominique Strauss-Kahn, who was like caught in some kind of orgy that he participated in a few times. In his defense, it was like not frenetic, if I remember his words.
French judges have called the former head of the IMF, Dominique Strauss-Kahn, the linchpin of orgies. Strauss-Kahn says he didn't know the women at the parties were being paid to have sex with him.
I mean, why do these people behave like pygmy chimpanzees, which, you know, they go into these like mass orgies when they find a new feeding ground of actual resources? Well, at least, you know, the chimpanzees, they engage in mass sexual activity when they actually find real resources, whereas banksters do it when they print more money, steal more stuff. So, I mean, you know, I'd rather be a chimpanzee. That's kind of off topic a little bit. But anyway, this is from an article from the Financial Times, FT, entitled, Investors Warn of First Republic Aftershocks at Gloomy Milken Gathering. The Milken Gathering is a gathering of big finance people that have a lot of all of our money, and they're discussing the banking crisis. And at the bottom of this article, there's a statement from Kristalina Georgieva, head of the IMF here. She blamed complacency for the U.S. banking failures. This has to do with complacency. We know there was unnecessary deregulation. Yeah, too much deregulation. Again, that word comes in. And now we saw the price to pay. We saw supervision has not been up to par. We need more regulation, more supervision, less complacency. Georgieva also warned that the rapid pace of the recent U.S. bank runs, which were fueled by savers' ability to move money online with a single click, would require a lot of new regulatory thinking about how we deal with this. That should chill you to the bone. What she's saying is people can't be allowed to move money so quickly because that makes bank runs really, really fast. It is the speed money can move from one place to another. It goes into the territory of the unthinkable.
Inconceivable! You keep using the word. I do not think it means what you think it means.
It's unthinkable that people can move money this fast. This should not be allowed because this causes bank runs to happen way too fast for us to counter them in any effective way. So get this. The head of the IMF is saying that bank runs happen because people can move money too quickly. So the solution is that we shouldn't allow them to move money right when they want to. We should lock their money in banks if they feel that there's going to be a bank run. So what do you think is going to cause a bank run if there's a new law that you can't take money out if there's a bank run? It's going to cause a bank run. But anyway, what's the real reason for the failure of regional banks? It's not because you can move money really quickly or because of deregulation. It's because of this. I looked at the annual reports of 3 regional banks by market cap, the first, second, and third biggest regional banks by market cap. The first is US Bancorp. So I want you to see what's going on here. We have here in the red rectangle that I put over there, we have here in the red rectangle where it says other comprehensive income or loss in parentheses, changes in unrealized gains and losses on investment securities available for sale, which is in 2022, $13,656 million. And in 2021, it was only $3.7 billion. In 2020, there was a gain, an unrealized gain of $2.9 billion. What were these losses concentrated in? Treasury securities and mortgage-backed securities. And why did this bank suddenly have so much treasuries and mortgage-backed securities? Because there was nothing else they could buy to cover all the deposits that were coming in from all the money printing of 2020 and 2021. The government encourages banks to buy its own securities, which are, of course, treasury securities, and they get the biggest percentage of tier 1 capital if they buy those. So they're incentivized to buy those because the government always wants to spend more money and wants low interest rates. So the more institutions it can encourage to buy its own securities, which are US treasuries, the more money it can burn and going to war and whatever else it wants to do. And of course, they want banks to buy mortgage-backed securities because that's what the Fed buys. So the banks are basically just copying the Federal Reserve, doing the exact same thing that they're doing. And this is by regulation. And what happens when you buy too much of one or two kinds of securities and they lose value altogether because interest rates are going up because the Fed keeps hiking interest rates? Well, you lose a lot of money. And then deposits start to fly out. And then your bank crashes. And it's the same story in every bank. Let's go to the next one. This one is Truist Financial, the second biggest regional bank by market cap. And you have here AFS securities available for sale. Securities is the same stuff that caused the failure of Silicon Valley Bank. You have here agency mortgage-backed securities, $65 billion. That is their biggest investment in terms of securities here. And the losses are about $10.15 billion. Total available for sale securities losses in 2022 was $12.27 billion. So as the housing market falls, so do these banks. If we go to the third bank, we see the same thing, but a little bit of a different permutation. That is Fifth Third Bancorp, FITB. You see here something a little bit different, but basically the same thing. They're available for sale securities are mostly, or the biggest portion of them, is agency commercial mortgage-backed securities. So instead of residential mortgage-backed securities, you have commercial mortgage-backed securities. All of these securities go down in value as interest rates rise. We have here a total of about $30 billion in agency CMBS and an unrealized loss of $3.5 billion. Total available for sale securities losses, $6.046 billion. Now, while both treasuries and mortgage-backed securities, whether residential or commercial, they all lose value as interest rates rise, mortgage-backed securities can go to zero if people stop paying their mortgages, whereas treasuries are much less likely to go to zero because the federal government is almost always going to pay its bills unless there's like a debt ceiling default, which, could never, ever happen. But we'll get into that in a minute. So the real reason that regional banks are collapsing is not because of incompetence or complacency. It's because the regulatory regime requires that these banks invest in the same stuff that the Federal Reserve invests in. So you have banks investing in all of the same crap. And then when that crap loses value, they all go down together. It's not very difficult to figure out, Kristalina. So we just saw PacWest fall yesterday, and we've seen what is it, 5 other regional banks fall in the past few weeks. But now let's get into where we are in the debt ceiling debacle. Well, we saw last week that Janet Yellen, Secretary of the Treasury, said that June 1st could be D-Day for debt ceiling default. And when we know if it's going to be June 1st or sometime in September, probably, we'll probably know by the time you're watching this video. And how is that? Well, look at this chart over here. This is the amount of money that is in the Fed's bank account at the Federal Reserve. Now, if you look at the months, the week of the year where we are at now, which is the first week of May, we can see here where I'm mousing over. Wednesday, May 2nd, 2012. We look at every year from 2012. That May 2nd was an intermediate peak in the amount of money the Treasury has, and it went down on May 9th. And if we go to the next year, in May of the next year, we have here topped in May 1st, 2013, 157 billion, and went down the next week, May 8th, to 144 billion. If you go to 2014, we see the same thing. If we go to the final week of April, or it was April 30th, April 23rd, it was already falling. 2015 was an exception where we had 219 billion on April 29, 2015, and 227 billion higher on May 6, 2015. And then money started draining out again. If we move to 2016, you can see that in the last week of April, it peaked at 346 billion and then started heading down from there. And we'll zoom out a little bit. And this is logical because tax receipts come in from April 15th until the end of the month. So sometimes the amount of money held by the Treasury peaks out in the first week of May, sometimes in the second week of May. The key is that if the Treasury's account at the Fed has topped out already at $291 billion, they will not have enough money to make it to June 15th. On June 15th, they get more tax receipts, and they will be able to reload that account a little bit, which should last them until September. If the account has already topped out, they won't make it that far. If there is another week of tax receipts coming in, you should be seeing that now. If the account tops out at just above 300 billion, they should barely make it to June 15th. So you should know it by now. We'll know pretty much exactly within a few days of when D-Day, default day, should be if they don't raise the debt ceiling. Because as we know, everyone is extremely principled in Washington, D.C. to the point that they will not budge on anything because it's all ideological purity. But anyway, let's move on to what's happening in silver. And there are some serious technical levels that could be overtaken at any point today, tomorrow, next week, but imminently. We saw that gold moved to new all-time highs last night, Wednesday night, when PacWest collapsed. So we're seeing that as banks collapse, gold moves higher. And, overall, as interest rates have been hiked now to 5.25%, I believe, gold has headed to new highs. So yeah, that myth of lower interest rates, higher gold, higher interest rates, lower gold, never pans out, hasn't panned out this time, isn't even true. But what is happening in silver? It's this. Now, if you look at the silver chart here, we are at a historical pivot point. If you go back to the years 2010 to around 2013, this point where we're at now, which is around 2640 about, this was a major pivot point in those years, 2010 to 2013, when silver last hit its highs of around 50. This was the breakthrough area where we broke out in 2010. We blasted through this, and it ended up as support, the final support before we headed straight for $50 in 2011. So it hit once here, and if you follow my mouse, it hit again here and hit again here. And so that's 1, 2, 3, 4, 5 times. And this was the breakdown, same area. And this broke down into the 2013 to 2015 bear market. Now we are back in that zone. We've been up and down, bobbing back and forth since the 2020 highs and since the silver squeeze highs. Now we are back there. And I think this time we are finally going to break through for good. And I think this because it's being confirmed in gold. Now, there's 2 triple tops here that I highlighted, and I put this on the Endgame Investor in Wednesday's report, I think. So we have here a potential triple top, and triple tops are very bearish. Argument for why this triple top will not hold, meaning we'll break through this top. And this is a little bit outdated, where I think we're at 2070 now, 2060, something like that. So we're now at that level that could confirm a triple top, but it's not going to happen, I don't think. Why? Because if you look back at this 2011 era in gold, we had an all-time high year of 1923 in September 2011, and then we made a triple top that was below the all-time highs right? This time we're formulating a potential triple top at the all-time highs, and that is very different than formulating a new triple top below the all-time highs. This is more of a bearish indication. This, if we break through this all-time high, and especially if we pass the psychologically important 2100, we could be off to the races here. And the other reason I say that is because the 200-week moving average has already been successfully tested around October. Same for silver as well. And we broke through back above, and we haven't tested it since. And we bounced off the 50-week moving average here. So we're looking very technically bullish here. I think we're imminently going to break through this top here. And we could be in a new era after that, especially with banking collapses proceeding as they are. Now, if we look at the silver to stocks ratio, the silver to the S&P 500 ratio, we're also at a very significant level here where the silver to stocks ratio, basically, this shows silver's performance relative to the S&P 500, and we hit a multi-generational low here at around 0.004, and we haven't been near there since. And now we're testing this resistance zone again, which was hit 1, 2, 3, 4, 5, 6. This is the 7th time since 2018. Broke through it once in the 2020 panic, and we're going to break through it again, I think this time for good as well. And silver will start outperforming stocks handily. This could happen at any time now. So don't try to time it exactly. Just get in if you need more positions. What I'm saying overall is that the metals are reacting very well to the regional banking crisis. Gold hit new all-time highs overnight, right as Pacific West or PacWest was announcing that it was looking to sell itself to whoever wanted to buy its assets. And it looks to me that as the regional banking crisis progresses, and it will progress, gold and silver will head higher and higher and higher. And at some point when the public gets involved, and not just the banks that are nervous, but the public itself is nervous, they will start buying silver more than the banks will start buying gold. And that's when silver will majorly outperform. And that could happen at any point. This is Rafi of the Endgame Investor. If you enjoyed this video, then sign up for a 2-week free trial of the Endgame Investor or become a patron on Patreon, where I give out a weekly biblical commentary on monetary and economic policy topics. And as always, I'll see you guys next week. And who knows how many banks will fail by then.